When you also look at risk, and if I can throw one more statistic at you just to sound a little smart here on this podcast, AB, you look at the Sharpe ratio for the S&P, which is effectively the return per unit of risk. It's 3 times higher than the long-term average. So there's been some magnificent returns out there in the US, not so much here in Australia.
I'm loving the use of these stats. I'm going to have to start referring to you as Poindexter.
That's me, yeah. I'll take it. I'll take it.
So that notion of the pricing of risk, I think, is something that's worth really acknowledging insofar as the potential return versus risk is at an extended level. In other words, risk is relatively cheap right now. And to that point, trades that we've been involved with talking about is a pretty protected position on the S&P where the insurance costs for 5 months are less than 3% of the value of the position. So if you think about statistically, you can be expecting 9% out of the index over the back end of the year. It's cost you 3% to insure it past the US presidential election. That effectively gives you a 6% risk, potentially 6% risk-free return on cash. Hey guys, welcome to this week's Money and Investing Show. This week we are doing a review of end of financial year. How have the last 6 months been across markets? What are some of the factors that have driven them on? And more importantly, what's coming around the corner to help you best prepare? As always, don't just simply take notes, make sure you take action. See you in the show. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitchell Olarenshaw.
Happy New Year, Mr. B. Here we are, end of financial year.
Indeed.
Without wanting to date this podcast, our topic of conversation today is to talk about the first 6 months for markets, both Aussie and US. And gee whiz, there's a paradigm difference between the US versus Australia.
Most certainly is, and I think that's a gap. I'm sure we'll get on to look at outlook as we get towards the back end of this, but that gap, I suspect, is only going to widen over the next 6 months.
Indeed, and we've been in a really interesting time for markets because we've seen such strong corporate earnings and growth in those earnings, and really the rally has been made up of really a few stocks, primarily the Magnificent Seven. With that said, though, if anyone who's an index investor in the US has really cleaned up the last 6 months.
Look, S&P 500, 15%. For the first 6 months of the year. That's on the back of, 24-ish% last year?
That's right.
The NASDAQ were up 19%, which is hot on the heels of 54% last year. They are stunning, spectacular gains. And if you compare that against the backdrop of an Australian equity market, which I think is about 1.8% up for first 6 months, there is a world of difference. And I guess we'll get into exploring why that is, but it's backing up on where it was. And a lot of people would probably feel that, it's going to run out of momentum. But you look at the modeling that's used, including what we use ourselves, and it's something like a 72% chance that there's another 9% left in the S&P this year?
Yeah, that's right. So since 1900, the run that the S&P 500's had the first 6 months of this year is the 21st best ever run. With the run that it's had, there's now a 72% chance it'll add on a further 9% gain for this year.
Well, so plenty left in there.
Yeah.
And again, that's the ability to take you to another 24% year for the S&P, which is staggering. And that drive up in price, of course, means that when you look at the valuation on the market, it probably looks a little bit more extended. Was it 26 times earnings now?
NASDAQ's about 26 times its earnings, 12 month. A year ago, it was 20 times, which gives you a good indication of the shift.
Yeah, so what that effectively means is that you need to own a share for 26 lots of earnings a season in order to receive an income to pay for the share. So it's net free cash flow share, which is P ratio to all intents and purposes. That was 20 times a year ago. So we can see that valuation as it extended up, which means on a traditional model, the NASDAQ looks expensive. All markets do when they've been on the kind of charge, of course, that they have been, but it has been supported by some really good earnings growth.
It has. When you also look at risk, and if I can throw one more statistic at you just to sound a little smart here on this podcast, AB, you look at the Sharpe ratio for the S&P, which is effectively the return per unit of risk. It's 3 times higher than the long-term average. So there's been some magnificent returns out there in the US, not so much here in Australia.
I'm loving the use of these stats. I'm going to have to start referring to you as Poindexter.
That's me, yeah. I'll take it. I'll take it.
So that notion of the pricing of risk, I think, is something that's worth really acknowledging insofar as the potential return versus risk is at an extended level. In other words, risk is relatively cheap right now. And to that point, one of the trades that we've been involved with talking about is a protected position on the S&P where the insurance costs for 5 months are less than 3% of the value of the position. So if you think about statistically, you can be expecting 9% out of the index over the back end of the year. It's cost you 3% to insure it past the US presidential election. That effectively gives you a 6% risk, potentially 6% risk-free return on cash.
It's a good way to stack the deck in your favor, for sure.
Take that every day. And that's without any options work on it too.
That's right. You could keep selling some calls, generate some income, plus maybe a few dividends in there as well.
Exactly right. So it is a misprice of risk, particularly when you look at what's coming down the line. But look at the last financial year. The real difference, I think, between the US and the Australian economy has been the way that the central bank has managed interest rates. I think Jerome Powell, and we've spoken to this many times now, has been exceptional in the way that he's communicated the Fed's position on interest rates and telegraphed very, very clearly where their intentions sit. And markets really like certainty. They don't like uncertainty. And I guess if your backstop is someone that's a great communicator, that's very transparent, that doesn't try and hoodwink you or surprise you at the 12th hour, that's where a little bit of this certainty and money flow into markets has more than likely come from. If we then contrast that to the Australian situation, where we've had a central bank where originally under Dr. Philip Lowe, and now with the new chair, the communication has been quite different. It's been quite opaque. It doesn't appear to have been on the front foot. We're now looking at the prospect, because of the way that interest rates have been managed today in Australia, that there's probably another interest rate hike. I'd say there's a reasonable chance of seeing that over the next couple of months.
Recent CPI figure came in higher than expected, 2 at 4%.
Yeah, and a Labor government that's been spending money like a sailor. Is no wonder that inflation is there and the central bank's got to ratchet rates up. It is very, very different. And I think that lack of certainty over the economy is then priced into equities. The US has been a lot more certainty over the economy, and that's why we've seen those great returns. And of course, notwithstanding, the nature of AI, for example, which has been through companies like NVIDIA, such a massive contributor to the index performance. But by and large, companies across the board have been quite strong. 74% of them beat earnings expectations by a reasonable margin at the last earnings.
It's what stands out to me is those micro factors, not just the macro. So micro factors, company earnings has been through the roof. S&P growth rate somewhere in the order of about 7 or 8% year on year. And as you say, most companies coming in above expectations. Anything with any mention of AI, with any improvement of efficiency, cutting labor costs, has just done wonders for stocks. Take NVIDIA up, a few 100% just this year plus last year, which is ludicrous.
Well, the talk is bubble's over and we've seen a bit of a pullback, but it's been on an absolute tear, and seeing a pullback that we've seen more recently is expected. Things don't just go bottom left, top right. That's not how it works. And so a little bit of a shift in money, maybe some people cashing out, some people FOMO pulling them in, and everything in between, which is, of course, the dynamic of markets. And I think, personally speaking, I think this is why I like index investing. It removes a bit of that stock-specific risk as well, and using ETFs to achieve that has been good. But it's been a very, very strong 6 months on the back of a very, very strong 12 months. And I think there's plenty more left in it. We're in an election year too, so you can't imagine that it's in anyone's interest to see the stock market soften off. So they're the tailwinds that we look for. And so many people, I think, make the mistake of sitting on the sideline. The market's already at all-time highs. So that means they're going to correct. Now they're at all-time highs, and they could potentially move to new all-time highs. And the number of new highs, I don't know the stat, you may have it to hand, of new highs that markets have set this year has been extreme again, which reflects the uptrend that, of course, it's in. From
the top of my head, I think it's roughly there's been 21 new highs made on the S&P this year.
Right.
So it's been a cracking year. The downside to all of this, though, AB, if we can kind of transition now into some of the risks, because it sounds pretty good on the surface, right? 15%, 19%.
Well, it's been pretty good.
It has been really good. We've made some great money out of it. But I guess looking forward for the benefit of our listeners here, 35% of the S&P 500's gain has come from 7 stocks, which is the Magnificent Seven. So NVIDIA, Microsoft, Amazon, and so forth. The market breadth did widen at the start of the year. It's since come back. And if I look at advancing stocks to declining stocks, it's about 3 to 4 times as many stocks that are declining now on average that are advancing. Yet you've got the indices at record highs.
So it's something that you've got to do the archaeological dig. You've got to dig a little bit deeper than just simply on the index. And you're right, that narrow breadth, and we covered this some months ago in terms of what that really means for markets. When you've got a flourishing market and a broad range of stocks are performing well, that ultimately is a very, very strong bullish market. When it is concentrated amongst a smaller denomination, that does increase risk, because as soon as the wheels come off for one or other of those, and perhaps it is NVIDIA, as we're seeing with some more aggressive price action of late, 600 billion or something wiped off its value in its biggest one-day loss in market cap.
Yeah.
But then you've got to look at the gains that it's made over the last 18 months as well, which are nothing short of astronomical. So yeah, when the wheels do come off, and if it is driven by a very narrow band of stocks, it can get pretty ugly pretty quickly. And again, I go back to the idea of A, investing in indices to avoid that, and B, the cost of protection. And probably my biggest position I'm running right now is fully protected for that reason, that if the wheels do come off, well, that's okay.
So market breadth a factor for markets right now. What about maybe the US election or potentially some stickier inflation? Because let's face it, we're not probably going to get a rate cut anytime soon. We certainly aren't getting one in March. I mean, we're now in July, right?
Look, the notion of a rate cut, let's talk to that one first up. And inflation has been showing signs of easing in the US, across a broad spectrum of indicators, not just simply CPI, but personal consumption expenditure and a few other things in that space, which anecdotally are the tool that the Fed uses. And some of the people I follow in markets, they're still quite vocal in calling for a September cut. I'm not so sure on that. I think it's likely to be later rather than earlier.
I agree.
And given the way that the Fed have done such a terrific job of really reading the data and using the controls accordingly, waiting an extra month to confirm that what you're seeing is there, I don't think is a bad stance to take on their part, in that if you held off a rate cut from September to October, just to make sure that September data was a continuation of the data plot that you're looking at to the downside, that inflation's easing away, would give a high degree of comfort and certainty in that first cut. And I say first cut because it's going to be the first of a cutting cycle. You don't want to go out too hard, and you maybe want to just have a little sample of how the market responds to that. So maybe we only see one rate cut this year, and maybe it's more likely October than September, although people way smarter than me are calling September. We'll see. And then moving into next year, the possibility of 2, 3, 4 cuts as we see that cycle change around. That's totally different to what we have ahead of us in Australia, where there's the likelihood of a rate rise. So talking to the US, a rate cut I think would be good for markets. It typically is. Certainly good for some of the bond positions that we're trading right now too. And the biggest risk is that rate cut doesn't happen, because it's almost expected now. And when you expect something and it doesn't happen, if you think about, sometimes you see kids at, say, Christmas, and they were expecting a particular gift from Santa, and didn't materialize, and the shoulders drop, and suddenly it's not the wonderful day that they were expecting. Horrible thing to see as a parent. Best thing about being a parent is when they're playing with the cardboard box that it came in, and rather than the hundreds of dollars of gift it was. But anyway, parking that for a minute, I think markets, if they were to respond in the same way that they didn't get the gift they're looking for from the Fed, you can see a little bit of a strop and salt coming on, and maybe some softness into that rate cut. So that's possibly a risk there if we don't see that. The interesting thing, is the way the mortgage market in the US has really matured since the GFC. Again, something we've spoken about, where people have taken really long fixed rate mortgages, 30-year fixed. So they've been largely insulated to this. So a cut in rates is likely to see a catalyst of transactions in the property market. The cost of moving reduces, and you may see, which is all good engine room stuff for that US economy and everything around that. So that would be a positive. On the AI side of things, the risk is that companies don't deliver on the expectation of AI. So this game-changing industrial revolution times 10 that people are expecting to see, if that doesn't start to come through, and you've seen, companies like big IT companies where, we're moving, AI is the big thing, we're shedding jobs. If the earnings growth doesn't come from that, then there's a problem, because they're already priced in a way that growth or that profitability is coming. But if it doesn't come, then there's only one thing to happen, and that's a sell-off. And I think that does remain quite a significant risk for markets.
What about the US election upcoming? We've just had the presidential debate, and it was great viewing.
Needed subtitles. Wouldn't want to have been trying to do the subtitles on one of them murmuring and stumbling his way through.
No.
I don't need to make any further comment as to what my view is on that. The election in itself, though, I think markets dislike uncertainty, and there's a reasonable chance that we may see I'd say it's a very high probability we'll see it swap out of the candidate for the Democrats. I just don't think Biden is capable of running for office, period. And I think anyone watching that debate would have to arrive at that conclusion. And it's a question then of who do you slot in? And, the three names seem to be Gavin Newsom, who's the governor of California, Hillary Clinton or Michelle Obama. And I think, Newsom would probably be the smart money choice there. But it's an unknown quantity for markets where you've got someone that's the governor of a state that's got cripplingly high tax and a lot of other problems with it too, coming to the fore. So sometimes what even if it's terrible, is better than the unknown, and that's certainly how markets look at it. So a switch out of candidate would have the potential, I think, to cause a little bit of choppiness in markets. The election in itself, I think a Republican win is likely to see tax cuts returned.
Which is a good thing for markets,
Which is a good thing
for
markets.
Corporate profits.
But I think civil unrest is the flip side of that, and we've got to be quite candid on how and what we talk about with this. But I think there's some trouble ahead for that the US as that election becomes closer, and I think markets will reflect that with a little bit of choppiness as we go into there. Irrespective of candidate and irrespective of who wins, I think we're going to see, unfortunately, a little bit of gnarliness there.
Gotcha. So for our listeners out there, there's a lot of good news surrounding the markets right now. We've had such a great start to the year. There's also some challenges that we could see upcoming.
Yeah. Look, a couple of other points to around that. I think the tariff war potentially. If President Trump's to be re-elected, he's made it abundantly clear that tariffs are a tool at his disposal, as he demonstrated during his presidency. We're also seeing the Biden administration, albeit late to the game, doing the same thing with EVs, and it's probably a necessary evil. But trade tariffs again are the sort of thing that can really turn into an escalation, as we've seen here in Australia. With our largest trading partner, when we had tariffs on wine and lobster and timber and all sorts of other things like that. That again can be a variable in the market. And geopolitically too, we haven't, there's a potential for increased conflict, depending on election outcome, what happens in the Ukraine, but also, the notion of China and Taiwan and that tension increasing too, which, there's a possibility that something could really kick off there, which would be, horrific for markets for sure. So there's all that risk there, which goes back to your stat on the Sharpe ratio. I think, risk is being underpriced right now in markets, hence why it's cheap to buy insurance.
Multi-year low for the VIX too, the volatility index, 100%. Very cheap.
So buying insurance to protect a portfolio makes huge sense when insurance is mispriced or cheap, to give you the peace of mind. And in case you're thinking, well, if it's going to cost me, as I used the stat before, 3% to insure out till I've got an S&P position running to pass the US election where I've got no downside because I've bought insurance. And if any of these terms don't make sense, click through to our website, have a look at what we do, because we can sort of help guide you through all that sort of stuff. And look, if I get to the post-election world and the market's 9-10% higher, I'll be happy with that. I'm not going to be complaining that I didn't use my insurance policy. And just the same way, if you get to the end of the year and you haven't had to make a claim on your car insurance, you don't tut and cuss around the house going, oh dear, what a waste of time, I didn't need to make an insurance claim this year. That's not a conversation you have. It provides that peace of mind. And I think in the good times, peace of mind is something that's very, very easy to take for granted. And I've had a lot of experience over 35 years around markets, and things can unsettle things very, very quickly. And at that point in time, you think, oh, gee, I wish I'd taken a bit more of a cautious approach to this. And that's not to say sit on the sideline and don't invest. It's invest, but be smart about what you do. Index rather than individual stocks, for example, buying insurance because it's underpriced, and giving yourself that ability to have the swing to the upside, the rainbow, without the storm, which I think as an investor is something that we all desire. That doesn't happen by accident. You've got to know what you're doing for that. And again, that's our bread and butter, our backyard, to help people understand how to do that. But crikey me, sitting here at the end of the financial year, looking in the rearview mirror at the last 6 months on the back of the previous 12 months as well, it's been phenomenal for people that have chosen to invest outside of the Aussie market. And I suspect that paradigm shift between the two is very much likely to continue.
Indeed. Well, let's hope the Aussie market can pull its weight and start to get back up there. But thanks very much for the insight today, Andy.
Absolute pleasure. Anytime, Mitch. There you have it, guys. Make sure you give us a review and a rating. Helps more people get the show. We look forward to hosting you next week.